Hey everyone, my name is Crystal, a CPA with Life Accounting, where we help you to save on taxes and build your wealth. And today I want to help you do this by going over 5 tax tips you should be aware of before the year is over. There's not too much time left before the year is over, but there is just enough time left for you to start thinking about ways you can reduce your taxes. And as we all know, if you want to owe less taxes when you file your return next year, you have to make wise decisions before 12/31. So, if you want to learn tax strategies to help you save on taxes, or if you ever wondered what you could be doing now to save on your taxes later, make sure you stick around until the end of this video for some useful tax tips. And be sure to like this video and subscribe to our channel if you don't want to miss out on future ways to save on taxes and build your wealth. The first tax tip to consider is to offset your investment gains with investment losses. This is a tax planning strategy called tax loss harvesting. How it works is you sell your losing portfolio investments and you can use those losses to offset your capital gains, resulting in less taxes due. If you don't expect those losing investments to come back up, make sure you sell them before December 31st. Or even if you do think they'll recover, you can always buy them again after 30 days. And let's say you have more capital losses than capital gains. You can still apply up to $3,000 in excess capital losses to other income you may have. If you have more than $3,000 in excess capital losses, the rest can be carried forward to future years. The second tax tip is to max out your retirement contributions. Tax-advantaged retirement accounts allow you to make pre-tax contributions that ultimately reduce your taxable income. Meaning, if you contribute $5,000 to your traditional IRA, you also get a $5,000 tax deduction. And who wouldn't rather pay $5,000 to themselves in a retirement account than a portion of that going to the IRS, right? Now, there are limits to consider, however. For 401ks, you can contribute up to $19,500. For traditional IRAs, you can contribute up to $6,000. And if you're a business owner with a SEP IRA, you can contribute up to $58,000. Also, the great part about this strategy is that the IRS actually gives you until the filing deadline, in most cases that's April 15th, to make these contributions. So you have a little extra time after 12/31 to take advantage. The third tax tip is to defer income. Income is taxable in the year it is received, but as a general rule of thumb, it is always better to pay tax tomorrow than it is to pay today. If you're a business owner, consider delaying invoicing your customers until the end of December to ensure you won't receive payment until January. W-2 employees have a little less flexibility in postponing their salaries, but you may be able to defer your year-end bonus to the next year, which you would need to confirm with your employer if that's possible. For both business owners and employees, you could also consider deferring your capital gains by not selling your winning investments this year and waiting until January 1 to sell. Now, of course, deferring your income only makes sense if you plan to be in a similar or lower tax bracket next year. You don't want to be hit with an even larger tax bill next year if additional income would put you in a higher tax bracket. The fourth tax tip is to accelerate any last-minute deductions. Similar to how you may want to defer your income to the next tax year, you may also want to consider accelerating deductions to this year. If you were already planning to take a business trip in January or February, consider taking it earlier in December to be able to write off those expenses. Obviously, with this tip, I'm not suggesting that you go and buy $20,000 in unnecessary business expenses, but I am suggesting that if it was something you were already planning, just go ahead and do it before 12/31 and claim those deductions. The fifth and final tax tip is to donate to charity. For tax year 2021, you are able to deduct $600 in charitable contributions for those filing jointly, even if you take the standard deduction. If you normally give to charity or your church, consider making an extra donation before the end of the year. Make sure the organization you give to, however, is a qualified charity and you receive a receipt for your donation. The good thing about this deduction is that you can write off monetary and non-monetary donations. So if you give clothes or furniture away, you can get a receipt from the charity showing the value of the items donated. And if you don't normally give to charity, just think about it this way. Would you rather give your money to a cause you really care about, or give all of your money in taxes to the government and have them spend it for you? All right, to recap here, the 5 tax tips to consider before the end of the year are: offset investment gains with investment losses, maxing out your retirement contributions, defer income, accelerating last-minute deductions, and donating to charity. Which one of these will you do this year? Leave your answer in the comments below, and I'll see you in another video.